What's up, y'all? Welcome back to the Propagate Fintech podcast. I want to talk today about a category of lender that doesn't get nearly enough credit. CDFIs. You've probably already heard this acronym, but knowing what they are and understanding what they actually do on the ground are two very different things. These are the organizations sitting in communities all across the country. They're scrappy, mission-driven, and they're filling a gap that the traditional financial system either can't fill or won't. My guest today is Kyle Lovell, Chief Lending Officer at Business Impact Northwest, right here in our own backyard. Kyle and her team have been doing this work on the ground in the community. And for the fintech and banking folks in this audience, listen closely to this one, because CDFIs are out here running a cobbled-together ecosystem, patching tools together that were never built for them. And that is not a criticism, that really is an opportunity. So if you are building lending technology, this conversation is going to tell you exactly where some white space is. And here's the interview. Kyle, thank you so much for being on the show. Let's go ahead and jump right in. So I think a lot of fintech and banking listeners are not really very familiar with CDFIs. You guys play a super important role in the ecosystem. Do you want to give us a kind of whistle-stop tour on what you guys do and how you show up in the community?
Yeah, for sure. Because CDFIs inherently are the other end of the spectrum than, what fintechs are. So CDFI stands for Community Development Financial Institution. We've been around for a long time, and we basically exist in order to get people to a place where they can access traditional financing, but they can't yet for any number of reasons. So I come from the lending side, but we also have an education component. I'll speak mostly about lending today, but really, whether it's time in business, derogatory credit history, lack of collateral, we really work to overcome hurdles on the way to financing for small businesses. So banks are the tried and true traditional method of funding a business, but they're regulated and structured, and a lot of people don't quite fit their credit boxes that are still valuable parts of our community and good investments. And that's where CDFIs step in. So we don't really want to be your forever bank. We really view ourselves as a stepping stone on the way to that traditional financing. And we can help, overcome whatever those banks perceive as hurdles on the path there. And, more than just money, which, everyone wants money, but we'll couple that money with education and advisory services that can really help guide small business owners, because they're expected to wear all of the hats, right? They have to market their business, they have to run their business, they have to design their business. So just having a coach that you can bounce ideas off of or help you run numbers or things of that nature can really also help streamline a business through periods of growth and planning and things of that nature. So yeah, we try to be the whole package, I guess.
Got it. So you guys are interested in being that stepping stone provider that's going to help them get from declined to getting the loan to replace the pizza oven or the tools that they need to run their business. I think that's awesome. You guys aren't going to try to get a bank charter like everybody else is these days?
No, it can't hold us down. So we enjoy the flexibility that comes with a CDFI status. And, our strongest partners are credit unions, banks, and things of those nature. They are really strong referral sources for us as far as who our clients are, and they can point people in our direction. But I think that we both need to exist. I think a cohesive environment, maybe with fintechs joining along, I think we each can do what we do well. And then that increases access for all of our small business owners, because they'll find the place they fit, hopefully.
Tide that lifts all boats. So, Kyle, one of the things that I'm excited about in this episode with you is people are going to get a lay of the land for what a CDFI does and their role in the financial ecosystem. What's in it for banks and credit unions in partnering with CDFIs?
We get them clients that wouldn't otherwise exist without us as a stepping stone, right? So because we have the luxury of funding startups. So typical underwriting, which is that risk analysis component that banks do, we do a very similar way. Like we collect, personal taxes, business taxes if they exist, projections, we run personal credit. So we collect a lot of the same information, but we can view it with an eye of context of like, maybe there was a medical bankruptcy. Maybe they had to take care of a family member and had to shut down the business for a while, so it didn't have a profitable year. And we are allowed to add kind of life's outside factors into our small business analysis, right? We can lend to people that banks just can't even touch. We have approved many loans, including a couple this month and last, with people with an under 600 credit score. Because I think that we still look at all of the components of a small business loan. Those 5 C's of credit historically are kind of what banks look at. And we still look at all of those 5 C's, but we can overcome a weakness in one with strength in another, right? Whereas banks require you to have all five.
And
And
so
I
you guys
think
are still looking at like many of the same KPIs and many of the same metrics and, debt to income, so on and so forth. But you guys have an additional kind of gut check, instinctual, like read on the borrower and their business plan and kind of how they're showing up.
yes, exactly. And we can, if we have a borrower that has a fantastic opportunity to move into a new location and they need inventory to fund that, but the cash flow shows that that business debt can't be supported. But we really truly believe that with this new plan and this new location and funding that inventory, that they will in turn be able to afford the debt. We can look at it in kind of that future view as opposed to looking at just the past, looking at just actually what happened. So yeah, we have that inherent flexibility. And also, this is the caveat of a CDFI is we're slow. And I think that is really a huge headache for us is because we individualize and personalize all of these options and really take our time. Oh, go ahead.
Oh, no,
Time
I was
to,
just saying, sure.
yeah,
Yeah, yeah.
yeah. Take our time to know borrowers. We're not quick, right? When we're I think balancing the expanded access that we provide by being able to build trust and, get to know our clients and whatnot, but also being aware of what they need and need quickly is kind of the crux of where CDFIs are right now. And I hope that's where, a fintech involvement can be beneficial to us and where we can still serve communities and hopefully do it faster. So
And so when
that's why
you,
I'm here today. That's my ulterior motive.
hey, fair enough. You got it. That's one thing that I love about CDFIs and just smaller organizations is that you really do have to be scrappy. So you mentioned fintechs, and obviously fintech is in the name here. What are there any fintech providers that you guys are working with that have been just like really awesome partners for you guys?
I think that it's fintech is such an emerging field still, and we're such an antiquated field that, at least in my experience, we haven't come together yet, right? I
Okay,
think
fair enough.
scrappy is the name of the game when it comes to CDFIs and what we do. We're not a depository, so we don't have bank accounts to lend from. So we have to source all of our loan funds. So we're really constantly looking for money to bring into the organization and then also looking at ways to get it out of the organization in the form of loans. So, that's been, and we've been doing that for years. I think the CDFI fund was started by the Treasury. I mean, I'm going to be quoted wrong here in print, but I think the 1950s. I think it's been around for
Okay,
a while.
okay.
And so I'm hoping with some integration of, the AI, the fintech space that, because like I said earlier, our strongest loans come from our referral sources of banks. And I think that if we can come up with a referral source to and from fintechs and make it a cohesive, communicating environment, we don't replace each other. We can only help each other, right? And so that's what I'm hoping to get from more talking to more people and understanding more, to be honest, because I'm an antiquated girl living my antiquated world. So I also have a lot to learn.
Well, it's a real challenging time because it's such a moment of change. And, AI is this thing that we all have to learn and find a way to integrate it into our day-to-day lives in the office and like how we execute. And the challenge with it is that it's so vast and it's so complicated. And I know this is a cheesy analogy because this is a bank, and financial services theme podcast, but I love golf. And I feel like one of the biggest challenges is that really have to figure out how you're going to learn because there's noise coming from the guys that you're in gals that you're on the tee box with are telling you like how to change your swing or more this or more that. And then there's YouTube and then there's golf teachers. And there's such a high volume of things to work on and also sources of information. You really have to like pick a way you're going to pull it off. I think the term is pedagogy, but then also like what you're going to learn, which I guess is, is the curriculum. Have you guys found what you're going to work on from an AI perspective in terms of integrating it into what you guys do?
We have determined our next step, but like you said, our next step is a baby step because one, it's a little terrifying, right? What if you pick the wrong lane and it emerges in this other
Sure.
place? Or like, what if the
Yeah,
tool that you've been dreaming of comes out 6 months from now and you've already spent your money on this other tool that now seems of the past?
I know. An agent or, whatever it
Yeah.
may be. Yeah.
And also, like, I mean, I work for a mission-based organization. We exist for more than just profits and getting money out the door. We exist to like help underserved small businesses, and they often require a level of handholding and touch that I really don't want to lose. So I think that, the emergence of cash flow underwriting, which is something the banker nerds will really dig
Oh
into.
yeah. We
Yeah.
covered this recently with American Bankers Melinda Husband actually about the rise of cash flow underwriting. It's a really like kind of, maybe more inclusive way, comprehensive way to look at a
Yeah.
borrower.
It's the new jam. I'm really into it. And I think this is where AI can be of an essential service to us, right? Because it can do cash flow underwriting and create financial statements from bank account data. And if you give, with this open banking, if you give access to your banking data of your small business bank account, what I imagine is that will help us get to a yes faster with like, I don't know what to call them, but like the gimme clients, right? The people that are surefire wins. Like the business can
Yeah.
support the debt. They have shown
Yep.
they're responsible with their personal debt and the business is established long enough to have that cash flow history, right? Like,
One of the big challenges that larger banks and credit unions have is that they find themselves spending the same amount of time on a $250,000 loan that they do on a $10 million loan because of, the antiquated processes and the manual kind of fallouts and the inclusion of spreadsheets. And so I know that that's a big kind of challenge for people when they're trying to work with small business. You're chasing around a lot of artifacts and documents and things that maybe, the business owner uh, misplaced or doesn't know how to find, and they need coaching and help. And um, it's a tough one. I wanted to draw you out a little bit on your guys' capital because you obviously are paying a much higher price for capital because you don't have deposits, right? To leverage. How do you guys go about raising money? Because I know that you've had challenges, and just the entire CDFI industry has had challenges from legacy sources of funds.
yeah, the legacy source of fund being the federal government. I mean, that was seen as the gold star of financing for a long time because it was, I think that um, as much as, getting a great grant is wonderful, consistency is really what helps us build an organization because we can plan. And we had consistency from federal grants for many years. And, those are, yeah. So basically, the way it works is we get money from a multitude of different sources, federal grants, state, city, county money, um, banks and credit unions that will lend us low interest debt. And we in turn kind of pool this money and then lend it out to small businesses. So it's always going to be a little bit higher than your conventional banks, right? Because
Mhm.
because the banks, we pay for the bank's money and then they pay for the loan money, right? So it's always kind of, that's a spread is on top. But that's, again, why we consider ourselves a stepping stone is we don't have prepayment penalties. We really want to see you go capture less expensive financing when you're ready for it. And we help coach you to get you there. But the loans that we have are anywhere from usually 5 to 10 years. And so we're constantly looking to fill our coffers of money to lend out, right? And so that's one challenge is getting, actual loan capital to get out the door. But then also I mean, it takes a lot to do what we do as far as time goes. So we need to pay for the staff to do that as well. So we need capacity grants as well as dollar grants in order to lend out, effectively, and like and keeping our mission and all those things in check and running these grants and doing the reporting. And we have it's a pretty complicated system for what is inherently a community need, a community service in a lot of ways.
Like
So
it gets
yeah.
harder than it feels like it should be.
Oh my God, it's so hard.
Why? Yeah. Why is it so hard to do the right thing?
Yeah,
Yeah.
it becomes,
Yeah.
it's exhausting to do
So
the
are
right
you
thing
guys,
sometimes.
is there like a diversification? Like there's such a rise in private capital right now. I have a group of friends who are putting together a fund to issue collateralized loans. And these are business owners who have capital that they're putting together to issue these loans. Is that an opportunity for a CDFI or is, yeah,
Yeah, you're actually the second person I've talked to this week about a guarantee program. So the way that works is it allows us to take on higher risk loans, right? Because the guarantee program, what it does is it collateralizes the loan, basically. So it allows us to still do our due diligence and still make sure that we believe the loan will get repaid. But if it doesn't, it lessens the hit on us as an organization and allows us to continue to exist. So we do it for our childcare programs up on Whidbey Island in Washington. And so we've been members of a couple different guarantee programs. It doesn't solve our problems of capacity as far as lending and manpower behind it, but it allows us to do our job better because it allows us to kind of take one maybe risky attribute and it lessens the blow there. So we still
hmm
would look at the capacity of the business owner, the financials, the business plan, the projection. So we still do our due diligence because I think we take our responsibility really seriously. The last thing we want to do is give out a loan that can't be repaid. Stressful for us, stressful for the borrower, bad
Sure,
for the community, all
sure.
of that jazz. So we really, make our mission to make sure that we're doing everything we can to make sure it can be repaid. But to not have to worry about collateral, which is what happens with guarantee programs, is a huge lift off of our, you know,
Right.
considerations because we're dealing with a lot of people that don't have generational wealth, which means they might not own their home. They might not, have the assets it takes to be able to secure larger debt. So it's really helpful. I know I just kind of hated on the changing funding in the federal government, but one program they do that I really love is the SBA's Community Advantage Guarantee, which helps
Mm-hmm.
bolster under collateralized loans as well. So it helps with security for the organization. Again, doesn't give us money, but allows us to do our jobs more effectively, basically.
Okay, got it. How do you guys do business development? Are you guys hanging out at the Chamber of Commerce, going door to door? What does that look like for you guys?
We get certain grants from like a chamber of commerce in order to come in and deliver a certain, educational opportunity targeted at a certain group of people sometimes. Like we did a food and farmer programming where it was just based around people that wanted to sell and grow foods and like local farms in King County, Washington. So it can get pretty hyper local. But in general, people will just come to us for advisory services and we can pair them with a coach who will get to know who they are and what they want to do and kind of one-on-one and you can set some short-term or long-term goals and really just help be there to guide the person down that path to help achieve those short-term or long-term goals, including like loan readiness. Um, I understand that applying for a small business loan is not easy. And so having someone to help you kind of prepare for that in order to put your best foot forward, I think is, can help you be more successful. But maybe you just want to know whether you should hire someone or not, or start an HR department, or maybe you need to open up a new revenue stream. It's just really helpful to have someone working with you on that as opposed to going it alone. No one likes to live, in an echo chamber alone.
Totally. Yeah. And, I think a lot of times business owners are, this is preaching to the choir here, but they're great at their business. They're a great baker, they're a great carpenter, cabinet maker, whatever it may be. But this whole finance world is a whole different animal.
They don't want to do their financials, and I get it. It's everyone's last priority, and I totally understand. I would be the same way, but it is like my favorite thing when someone can produce a profit and loss and a balance sheet that's like relatively recent. I'm always like, that's a really good sign for me. So
That's awesome. When you look at your entire supply chain in terms of how you guys get from an application coming in, your team analyzes it, reviews it, and you guys get to a yes or a no, if you could pick one thing to totally automate to get the human being like out of the mix on, what would you do? Would it be spreading? Would it be debt to income?
It would maybe be spreading those year-to-date financials, because so often, we can rely on taxes, but those are a point in time. And also, sometimes people want to keep the tax man out of their business and they do a bunch of write-offs in order to make, I get the different perspective of business owners have at a different time. And you don't always know you're going to apply for a loan the year prior. So you don't know to make yourself look profitable on your taxes. Hindsight's 2020. And also, I understand that. So I think that, yeah, I'm really excited about this cash flow based underwriting, because we can see what goes in and out of a bank account and know whether you can support the debt by those financial statements, which are going to be accurate, because the number of inaccurate financial statements we read through is pretty incredible. It can also identify debt that we maybe don't see showing up on a personal credit report. Um,
Like buy now, pay later stuff.
Yes. Or what is the scourge of my existence is the merchant cash advance loans. Your Squares, your Intuits, your things of that nature. I hate them. I understand that they're easy and accessible, but I also think they're really predatory. I think they
Mm,
hide fees. They're not technically loans, so they can use factoring rates. So the APR is out of control. It's because it's based on cash flow. If you do really well, you end up paying back even more. And it can just like really pinch businesses' cash flow, and you can end up stacking. So if you get one, your odds are you're going to get another, and then it can start to snowball. And they're my most hated thing that exists right now,
mm,
because they're for small businesses. There's no consumer protections around them, so the rates they can charge are crazy high. Um, but we also want to be able to identify them when we're lending, because if you don't disclose those on a balance sheet and if you don't see them show up on your personal credit report, those can really easily also slip under the rug during underwriting. And odds are they'll be found eventually. But also, we don't want to put you through the loan process to get to a no. It's a lot of work,
right,
right?
right. So we're talking about cash flow underwriting. Is this like a newly enabled tool for you? Did you subscribe to something from like Equifax that's now allowing you to do this, or how is this now available to you?
It's something we're implementing. So we are currently updating our loan management system. And then once that update is complete, I think it's called Laser Credit or Laser Pro, we're going to connect them with Salesforce and our loan management system. And we could always look at people's banking. We used Plaid for our bank identification, just to make sure that, because we're a small business lender, we can't do consumer loans, so we can't give money to a personal account, right? So we need to verify that it's a business account that it's going to, and it's a fraud prevention. We need to make sure it's the business we're dealing with, right? So we've always had access to bank account information, but this is actually the time that is going to be saved, and the accuracy, no more human error, ideally, that's going to be created by having this kind of automatically reviewed, is going to be incredible. I have only 2 underwriters. Like, it's a small team.
Sure. Yeah,
And
yeah.
so, if we want to do more than 10 loans a month, they can't be bogged down in 12 months of bank statements trying to sort what's going in and out. So
Right,
it'll be,
right.
yeah, I'm looking forward to that immensely.
So
Goal
you guys
is
are
end of this year.
so you guys are installing Laser Pro or maybe Decision Pro, a
Yeah.
Finastra product, right?
It's definitely not Decision Pro. It's Laser Credit, I want to say then. But yeah, there's a couple things we're integrating that we're excited about.
Got it. Okay. And then how do you guys do documents, like compliant documents? Is that um are you guys using like attorney generated documents? Are
They're
you
yeah, they're attorney generated documents, but we can change the templates, and they're just created through our loan management system. They pull all the details from um the CRM and just populate the loan docs with those. So, um, and we use Adobe Sign, except
okay?
for the SBA, who still requires a wet signature. So,
Oh, old
yeah,
school.
we're an SBA microlender. Those are loans that go up to $50,000. And I think like 40% of our loans by number are microloans. So they're competitive interest rates. They're the cheapest loans we have, right? They're the lowest interest rate. But boy, howdy, are they the most work in order to kind of make sure you're checking all the boxes.
Oh yeah. Oh yeah. That's wild that it's still so manual and there's so
Yeah.
much human intervention in the mix like that.
It's like crazy. And like they prefer blue ink signatures at that. So it's not even just a wet signature. They prefer they are not black, that they're blue ink. So, but I
Okay.
mean, also
Interesting.
with that, the caveat is the SBA microloan is one of my favorite grants because they give us inexpensive loan capital. And also, they will pay
Yeah.
for our capacity. Like I said earlier, they pay for payroll. They pay wages for the loan officers, the underwriters, the servicers to kind of get that stuff done. So without those arduous loans, it would be much harder for us to exist.
Well, Kyle, it's been great having you on the show. Where can people learn more about what you guys are doing?
Let's see. So businessimpactnw.org. So businessimpactnw.org. And then, I don't know, hit me up anytime. We're doing events. We're around.
Okay.
We are a Seattle-based company. So a lot of the events we do are based in the Seattle area. We were born out of a Seattle dream, right? That we used to be called the Seattle Economic Development something or other. But since we've expanded, we're trying to have more events in the other 3 states. And yeah, but I would recommend start at the website. All the good stuff is there. And I just updated my headshot, so I look better than ever.
Did you find it? Did you go the AI route? Did you hire somebody?
Put it through AI.
Oh, busted. Yeah, we did the
It was
same
an
thing.
iPhone
So.
photo that I was like, maybe a little less wrinkling here. Okay. So, and I had to give me a necklace. I had to give me like a gold chain necklace.
Dang, ballin'.
Yeah,
Okay, cool.
basically.
Nice. Yeah, no, the headshot photographers I think they're a dying breed, unfortunately.
Yeah, there's a lot of changing things in markets right now that's a little bit ridiculous.
Well, awesome to have you on the show. Thanks so much for being here.
Of course, yeah, really nice to speak with you. And yeah, see you soon.